Welcome back to educator.com. Today we're going to go over banking and the money creation process. So these are lectures that you want to make sure you go through. As we go through them, we're going to get a better understanding of how the Federal Reserve works, but we're going to have to get a little background before we get into the Federal Reserve. So in today's lesson overview, we're going to review the monetary role of banks. We're going to understand the problem of bank runs and how that might actually pose a problem when we're dealing with the banking system. And we're going to examine the three features of bank regulation, again, designed to prevent bank runs. We're going to describe how banks actually create money. We're going to determine how excess reserves can create money through a process called the money multiplier formula. And finally, we're going to discuss how the money multiplier actually works in the real world. So we're going to look at like the theory behind it to be able to get some questions on this AP exam that deals with money multiplier. But then we're going to talk about how it actually plays out in the real world. Because as we know, what's great in theory doesn't necessarily play out in the real world. Okay, so what do banks do? Okay, banks are financial intermediaries that use liquid assets in the form of bank deposits to finance illiquid investments of borrowers. So, I mean, simply put, banks make money off of your money. So they act as like an intermediary. So you have a depositor putting in large amounts of money, and they actually take that money and they lend it out to other people. So you have some savers and you have some borrowers, and the bank acts as an intermediary, and they make probably a nice profit in the process. At the same time, banks have restrictions on how much they're allowed to lend out. So if they lend out all the money that they have, then you have a problem. Obviously, they're not going to lend out 100%. On the opposite end of on the spectrum, if you don't permit banks to lend out any money at all, then it's not really a bank. It's a place where money is just stored as a vault, which, there are different places that do that, but it's no longer a bank. It's just a vault, right? So currency in bank vaults and deposits held at the Federal Reserve are all called bank reserves. So it's actually not part of currency in circulation. It's not in the hands of the people. So it's not actually part of the money supply yet. Okay. So let's take a look at what assets are and what liabilities are from the perspective of a bank. And again, this might not sound the most intuitive because most people may look at a loan and say, oh, that's a liability. I have a mortgage to pay off. That's a liability. But keep in mind, banks are working from the opposite side. So what would be a liability to you is actually an asset to the bank, and it could be it works the other way, vice versa. So let's say Parks Place Bank has loans of $1 million and reserves of $100,000 with deposits of $1 million. And how would it look? How would the T-chart look like here? So put assets on the left side and liabilities on the right side. So nothing complicated here, just to give you an understand, how you would draw a very simple T-chart using very simple figures here. So if you have assets here on the left-hand side, and then you draw a T-chart like this, and you have liabilities. Okay, let's use red here. You're in the red. Well, what are the assets? So if you have a loan of $1 million, then presumably some guy who is approved for a huge loan maybe put a deposit of $200,000 or $300,000 and is gonna bought a $1.3 million house, put in a deposit of $300 and took a $1 million loan from the bank. So the asset to the bank would actually be $1 million. So $1 million would be an asset because that's a loan. And again, this might sound strange coming from a consumer standpoint, because anytime you look at loans, if you're in the process of applying to colleges and you're applying for all these financial aids, well, any loan that you take out is going to be a liability on your part. Now, from the perspective of a bank, then it's an asset because they're owed that much money back, and that's a way to generate current income. Whereas a reserve of $100,000, that's pretty standard, really. The idea that the reserves is an asset because that's money that you have that you can spend out. Now, again, that $1 million loan that you have as an asset, really, it is an asset, but it's fairly illiquid because you can't force someone that has a 30-year home mortgage to pay back immediately. So you're gonna recover some of that over time. So some of the assets, when the loan is reduced, then you recover that. So banks actually, they don't necessarily want loans paid back, because if they paid back all their loans, then the source of gaining interest from money, it just simply doesn't work out. And so the liability would be $1 million, because the amount that is in deposits would be a liability, because you deposited $1 million into Parks Place Bank, then I'll hold on to that $1 million, and guess what? If you want that back on demand, I'm going to give you $1 million back. And that's kind of the whole purpose of what banks do. They take money and they lend it out, and you're going to have a problem. Hopefully you get this. If you only have one customer and you take in $1 million and you lend out that $1 million, and you only have $100,000 in reserve, then you're gonna have a problem, because if your customer is gonna want to take out more than X amount, then you're gonna have to borrow and figure out a way to make it work. So that's basically what you would put under the asset category versus liability category from the perspective of a bank. Okay, so here's the problem with bank runs here. So banks have no problems on most days because only a fraction of its depositors want their funds dispersed in cash. So you go to a bank on a normal day, you're waiting in a bank, and someone takes out $20, $50. They're going to hold on to most of their cash in the form of deposits, right? But what if all depositors tried to withdraw their money all at once? What would happen? There's a movie called It's a Wonderful Life, and this is kind of the basis of this movie. If there's a bank run, people are unsure about their banks and what's going to happen. And so let's say there's a rumor about a financial trouble with a particular bank. Let's say it's not true, but people believe this rumor. Well, depositors might leisurely withdraw their funds, maybe not go in a rush, but withdraw some funds little by little at first. But then what's going to happen is that other depositors are going to hear that so-and-so person withdrew their money from the bank, and so more depositors will follow suit, and then it creates a panic because this is John is a very rational guy, and so is Leo, and so is Yong and Ed and Alan, and they're all withdrawing money from the bank. Then what's going to happen is that it's going to create a panic, because the thought of other depositors panicking will actually lead to a panic. So you have what's called a self-fulfilling prophecy. So you have this bank run, and banks have lent out 90% of the reserves. People want their money. They don't have their money, and they're out. So they lose the money, and you have a bank run. So before the Federal Reserve, you would have an instance where a lot of banks, maybe if they weren't very well managed, you'd have a little bit more bank runs than you had today. So that's basically the problem with banks and a fractional reserve banking system, where you're lending out more money than the bank actually has in terms of assets. Okay, so as a way to try to regulate that, so there's some bank regulations that are put into place. There's deposit insurance, capital requirement, reserve requirements, and there's something called the discount window that we'll briefly discuss here. So the first situation here, deposit insurance. So currently the FDIC, or the Federal Deposit Insurance Corporation, the FDIC, they insure your deposits of up to $250,000 per account. So let's say you have 2 accounts with Bank of America. You have a savings account and checking account, and you have $490,000. Well, it makes sense if you really want that 0.1% interest, then you might want to put in the savings account, all of it. But the danger is that if the Bank of America, however unlikely, if it goes under, then you're only insured $250,000. Where if you split it up, $250,000 and $240,000, then you can theoretically, you're going to get back all your money in case the bank fails. Okay. To avoid a moral hazard, banks are required to have capital worth at least 7% of its assets. So to prevent banks from taking maybe unnecessary risks, then there's a minimum requirement that's that banks have to adhere to in order to comply with this idea, so that they don't go into thinking, oh yeah, we're just going to recklessly lend out, because if our customers lose their money, well, they're compensated. So there's things set in place to try to prevent bank runs, right? And more specifically, the Federal Reserve, they have what's called a reserve requirement, meaning that they have a specific percentage that can be lent out here. So the required reserve ratio, or the RRR, okay, so kind of like a sound that a seal makes, RRR, okay, it stipulates that banks must keep a certain percentage of its check deposits as cash. Currently, it's at 10%. Or 0.10. And again, chances are, if you're watching this right now, the RRR is currently at 0.10 or 10%, because the Fed really doesn't change this, because if they do change it, it really has a drastic effect. So we'll learn a little bit later on the functions of the Federal Reserve. But what the Federal Reserve generally does is it uses open market operations, or it sets a target federal funds rate, and it will buy and sell bonds based on that. So that's the primary function the federal fund traditionally has used or will use in order to control the money supply. It generally won't change the federal or the required reserve ratio, although it absolutely has the power to do so. Now, in emergency situations like in 9/11, the Fed will lend directly to banks through what's called the discount window. And that's exactly what the Federal Reserve did. It opened the discount window and basically wanted to, calm the markets and, say that the Federal Reserve is there to supply liquidity needs to banks. So banks weren't in a situation if customers didn't have adequate access to cash. What the Federal Reserve did was it allowed banks to borrow directly without some of the normal red tape that would be accompanied in non-emergency situations. So September 11th was kind of a good example where the Fed stepped in and it kind of quelled a mini panic that may have erupted when people wanted to withdraw money from their banks. So the Fed said, well, if you want to withdraw money, then we'll provide banks the opportunity to borrow money through the discount window. So this is how the money creation process works. This is how banks will create money. So let's say you have a random individual. Let's call her Juliet. Great name, Juliet. Juliet. So let's say Juliet in the first round, she holds on to her money. Okay. So she puts $1,000 under her mattress. Okay. And she didn't put any money in her bank. So there's nothing in the bank here. And so the total money supply would be, you add this here, you have $1,000 in the first round. So $1,000 under the mattress, that's the money supply in the first round. Well, Juliet realizes, the mattress isn't really giving me a high interest rate. So I'm going to deposit it into Wells Fargo. She banks with Wells Fargo, first checking account that she opens. And so Juliet, what she does, she deposits all $1,000 in cash. And actually, let's say it's Chase rather than Wells Fargo. So Chase, she deposits to Chase, and Chase lends out its maximum amount, which is $900, because it must hold on to $100 or 10%. And Zach comes and borrows $900. Well, guess what? What's in the money supply is that original $1,000 deposit by Juliet at Chase Bank. And so the total money supply out there is $1,900. So even though the original amount was $1,000, there's $1,900 in money supply because there's $1,000 in checkable bank deposits plus $900 current in circulation. And then let's just take one more example here, the next round here. And let's say Zach deposits $900 into his bank. And what Susan is going to do, so Susan, she's going to borrow money. She's going to borrow $810 because, Zach's bank is going to lend out 90% of that $900 that is deposited into Zach's bank, and $810 is lent out. So the money supply goes from $1,900, and then you add $810, and you have $2,710 from an original $1,000 deposit. You keep on going, and it basically goes on. And so this is how the money supply is created based on what the reserve ratio is. Let's say, again, banks hold on to the the minimum amount required, the required reserve ratio, and they lend out the excess reserves. And each round, more money is created. So banks aren't physically just going from a helicopter and throwing money into the population, but it's this idea of lending out more and more money, and people redepositing money and more money being created. This is what the money multiplier process is all about. So the money multiplier formula. So the excess reserves, these are banks' reserves that's above and beyond the required reserve ratio. So a very simple example. Let's say if the RRR is 10% with $1 million in checking deposits, the excess reserves initially would be $900,000. Okay, meaning that, let's say the bank doesn't lend out any money because the required reserve ratio of 10%. Okay, so if the RRR is 0.1, okay, then $100,000 would be the required reserve ratio. So again, if $1 million is deposited and no money is lent out, then the reserves are $1 million, of which 100,000 is required and 900,000 is excess. So again, this is where assumptions are made, assuming that there are no leaks and all money is lent out. Assume no leaks and that banks lend out all excess reserves. How much would a 1 million deposit increase the money supply by? So the way you actually work this out, the formula, you take this initial deposit times 1 over the RRR, and then you get the increase in money supply. Okay, so $1 million times 1 over the RRR is going to equal a $10 million increase. Okay, so this is why the idea of throwing money into the economy, it's not just that money, it's that money that's deposited and lent out and redeposited and so on. And if you keep on doing this with no leaks, then theoretically $1 million is actually $10 million. Again, this is kind of a good theoretical thing, but again, according to the money multiplier formula, this is the actual money that would be created, assuming no leaks. Okay. Now, in the real world, this doesn't actually work out that way. So not all people will deposit money in the banking system. Some will just hold on to cash. And if that's the case, then the money multiplier is actually reduced. It's not going to be 10. It's not going to be 1 over 0.1. It's not going to be 10. It's going to be significantly lower. But this is where you have to understand the difference between the monetary base and the money supply. Okay. So the monetary base is going to be all the currency in circulation, and then you add the bank reserves. So that's the kind of the base of the money pool that we're working with here. And it's good to understand it's the Federal Reserve that controls this money base. So they're the ones that control the money supply and interest rates, and they're trying to affect the money supply. So they do it indirectly, but they have this power to kind of alter this money base. And then that leads to a change in money supply. It doesn't necessarily work exactly how they planned, but they have incredible, some may say monopoly power on the supply of money. The money supply, on the other hand, is the currency in circulation plus the checkable bank deposit. So that's the actual money supply, the M1, the amount of money that's out there in the economy. And so the money multiplier is going to be the ratio of the money supply to the monetary base. So as I said, the money multiplier is, in the theoretical, assuming no leakage, it's going to be 10, right? So the money supply can be, created 10 times that amount if people keep on checking, putting money into the bank and lending money out and so forth. The multiplier can be as high as 10 with a reserve ratio of 0.1, because you take 1 divided by 0.1 equal 10. Now, obviously, in the real world, you're not going to get something, you're not going to get that high. There's going to be some leaks in the process. So what they found is that in normal times, I don't know necessarily, basically in non-great recessionary times, the money multiplier was found to be closer to 1.9. So a far cry from the 10 that you're dealing with the formulas in order to try to figure out the money multiplier here. In 2008, the money multiplier was smaller, and it was estimated to be 0.8. Okay, so what you have is that even though banks had the ability to lend out excess reserves, what you found is that banks lent out even less money. Thus, more money leaked out of the system. So when banks aren't lending out money, they're just sitting in banks, and people aren't able to get loans, and that kind of freezes credit, and the money supply is shrinked, and there's less economic activity that goes on here. So this is kind of a visual representation. So on the left, you draw the bank reserves here. So this would be the bank reserves. Okay. On the right hand side here, you're gonna see the this is gonna be the currency, or the checkable deposits. Okay, so you have this situation right here, and this, this amount here. If you take a look, what's being connected here is the currency in circulation here. So on the left is the bank reserves. On the right, you have the checkable deposits, and kind of in the center, connecting the two, is going to be the currency in circulation. So this amount right here, so let's call this circle right here is going to be 1. So 1 is going to be the monetary base. And this area plus the currency in circulation, that is going to be the money supply. And the multiplier is going to be the ratio of the money supply over the monetary base. So again, in normal times, maybe, again, 1.9, so the money supply would be nearly 2 times the money base. To give you an idea of how bad things were during the Great Recession of 2008, the money multiplier was smaller, meaning that it was less than 1. So there's less money supply, so there's less currency in circulation and checkable deposits. There's less checkable deposits than there were in bank reserves. So banks were just holding on to their money. And again, this may have prevented some inflation, but it really hurt businesses when there's not a lot of loans being lent out. There's not a lot of things going on in the economy. So let's go ahead and take a look at example number 1. So the amount of money that banks hold onto that's not part of the required reserve ratio, or RRR, is called which of the following? So this one's a very simple definition here. So surplus reserve sounds like it could possibly be the case, but that's not the technical term. Excess reserves, that's the money that banks are required to hold on to, or the money that's required is required reserves, and then anything that they're not required to but they hold on to, that's the excess reserve. So that's going to be the correct answer. It's not the reserve requirement, it's not the monetary base, and it's not the money supply. Again, monetary base is going to be the currency in circulation plus currency in circulation plus the reserves in banks. And what's the money supply? The money supply is also the currency in circulation plus what? It's going to be the what you have here is, in this case, it's reserves in banks, and this is the currency in circulation. And what you have is the checkable bank deposits. Kind of escaped me for a second here. Checkable bank deposits. So this money supply is M1. Okay, example number 2. The monetary base equals which of the following? So again, this one, we've gone over, and again, if you kind of have a basis of understanding this, if you kind of own it, then you'll be able to kind of graduate into some of the a little bit more difficult concepts of the Federal Reserve here. So the monetary base is going to be the currency in circulation plus bank reserves. Okay, so if you know it, then this is the type of question you might want to answer first and then see the answer choices here. So currency in circulation, that's not enough. That's only one part of the equation here. Reserves held in banks, again, if it's A and B combined, that would be correct. So currency in circulation minus the reserves held in banks? No. Currency in circulation plus reserves held by banks. That is absolutely correct. D is the correct answer. So money that is in circulation plus the reserves that banks hold, that's the monetary base. And this one is a little bit more convoluted, but let's take a look. Reserves held by banks minus currency in circulation plus the money supply. Well, what is the money supply? The money supply is the currency in circulation plus checkable bank deposits. So if you want to figure out reserves held by banks minus currency in circulation plus currency in circulation, so these cancel out. So reserves held by banks plus checkable bank deposits, it would be, if you're looking at this, it would be this part here of the money base. This would be the money base, or the monetary base here. So the monetary base, only looking at the bank deposits. And then here would be the checkable bank deposits. So reserves held by banks minus currency in circulation plus money supply would ignore all the money that's out there in the form of cash and coins. So that's incorrect answer. The answer is D. Currency in circulation, this is here, plus the reserve held by banks, which is the monetary base. Okay. Third example, I have three different parts here. Let's take a look at this here. How will each of the following affect the money supply through the money multiplier process? Explain. Okay. Let's say in the first situation, people hold less cash. So what does that mean? If people hold less cash, then they're going to put it into banks. So if they put it into banks, there's more money that's available to be lent out, and therefore the money multiplier, there's more money that's created. So more money for banks equals an increase in money supply. Again, assuming that banks will actually lend this money out. So all things constant, when people hold less cash, they're going to actually put money into banks, and there's going to be an increase in the money supply. Okay, let's say banks hold more excess reserves. So if banks hold more excess reserves, less money lent out equals there's going to be a decrease in money supply. So less money lent out equals less deposits, and therefore less money supply, less checkable deposits here. So there's going to be a decrease in money supply. Okay. And finally, what happens if the Federal Reserve decreases the required reserve ratio? So let's say it used to be 10%, say they drop it down to 1%. Well, if that were the case, let's say $1 million deposit, okay, in theory, if the money multiplier is 1 divided by RRR, or the initial deposit divided by the RRR, or initial deposit times the money multiplier, which is 1 over RRR. 1 million divided by 0.1 equals 10 million. So $10 million created. Okay. Now, if the reserve ratio is dropped from 10% to 1%, that would have a tremendous impact on the money supply. It would increase. Okay. So to give you that example here, 1 million divided by 0.01%. So that money multiplier process that happens and happens and happens, the increase in money supply would be $100 million. So that'd be kind of a scary economy to be living in with this increase in money supply. You only deposit $1 million and $100 million comes out. Okay. And the final example, let's assume this reserve ratio of 10%. So if a bank has deposits of $100,000, so that means it's a liability of $100,000, and holds $10,000 as reserve, so that's the required reserve ratio. How much are its excess reserves? Okay, so meaning that, let's say $90,000 was lent out. It lent out $90,000. Then how much of that $10,000, assuming an RRR of 10%? Well, if the RRR is 100,000, okay, again, times the multiplier, which would be Actually, there's no multiplying right here. So if it's $100,000, 10% of that is going to be 10,000. That's the required reserve. So if the ratio is 10%, so the RRR equals 10%, the required reserve is going to be $10,000. Well, if the total is 10,000, the excess reserve, zero excess reserve. So there's no excess reserves. So if a bank puts himself practically in this position, it's kind of a precarious situation, because chances are if someone takes out a deposit, then they're going to have to borrow money either directly through the Fed or through the Fed funds process, because they don't have the money. So they're going to have to meet the requirements set by the Federal Reserve. And so they're going to loan money either through the federal funds rate or through the discount rate somehow. Okay. Now, by how much will an increase in excess reserves of 20,000 generate in the money supply using the money multiplier formula? Again, very simple equation. You have $20,000 in excess reserves. Multiply 1 over RRR, which is 0.1. And again, the multiplier is going to be 10 in this case. So you have 20,000 times 10. So the increase in money supply according to the money multiplier formula is going to be $200,000. So again, this is assuming that there's no leaks and the money is multiplied fairly rapidly. But in the real world, you have money multiplier formula of 1.9. In times where people aren't spending a lot of money, then it might be closer to 0.8. What a disaster it would be in our economy if our money multiplier formula was 0.1 or 0. If people weren't borrowing money, the way we have our economy set up through banks, it'd be a severe shock to the system if people just stopped lending. If banks for some reason stopped lending out, it shows you how reliant our economic system is on understanding this banking process and kind of navigating through the system. Thank you for watching Educator.com.